Write a valuation methodology with precision equity valuation English. Welcome! In this section, we'll show exactly how we valued the company, clearly and briefly. You'll see the methods we used, the assumptions behind them, and why those choices fit the business. Our goal is to help any reader follow the logic without guesswork. We'll use precise language, quantify where possible, and explain sources so you can judge credibility. By the end, you'll understand not just the number, but the reasoning that supports it. Think of this as a transparent roadmap from inputs to valuation, designed to build confidence in the result. We apply 3 standard frameworks: DCF, discounted cash flow, trading comparables, and precedent transactions. The choice aligns with the business model. For cash-generative, forecastable businesses, DCF captures intrinsic value. For market context and relative positioning, trading comps show how peers are priced today. For control perspectives and synergy expectations, precedent deals provide transaction benchmarks. We identify a primary method, the one most reflective of fundamentals, and use the others for triangulation, checking consistency, and anchoring a reasonable range rather than chasing a single point. We model what drives results, not just totals. For revenue, we specify drivers like customer adds, pricing, churn, and expansion. For margins, we outline the path, gross margin mix, operating leverage, and planned cost efficiencies. We state WACC, terminal growth, and exit multiple, with brief reasons and sources. For example, capital structure from filings, beta from a peer set, and growth aligned to long-term industry outlook. Every assumption is linked to data, company filings, management commentary, audited metrics, and independent market reports, so the forecast ties back to observable evidence. Strong valuation writing uses verbs that signal method. We assume inputs where evidence is limited, estimate when we compute from observed data, derive when a figure is implied by a formula, and triangulate when multiple methods converge. We quantify ranges, e.g., WACC 8.5 to 9.5%, and cite dates for data, e.g., as of Q2 FY 2025. We avoid vague terms like some, many, or good growth. Instead, write, net revenue grew 12% year over year, or churn improved by 90 bits per second. Precision builds trust and makes assumptions testable. We specify the forecast horizon, e.g. 5 years, and define free cash flow clearly. For example, FCF to firm equals EBIT, 1 tax, plus D&A, CapEx, delta NWC. We outline the discount rate buildup, risk-free rate, equity risk premium, beta, sourced from a peer median, adjusted toward 1.0, size or country premiums if applicable, and after-tax cost of debt, then weight by target capital structure to get WACC. For terminal value, we state the method: Gordon growth with a conservative long-run growth rate, or an exit multiple consistent with normalized peer trading levels. We define the peer screen by size, revenue or market cap bands, sector/subsector, and geography to ensure comparability. We select valuation metrics aligned to economics: EV/EBITDA for capital-light cash flow, PE for mature profitability, revenue multiples for early-stage growth. We state the time frame, LTM, NTM, or FY+1 consensus, and how we handle outliers. For instance, exclude negatives, Windsor's top/bottom 5%, or weight medians over means. Clear rules prevent cherry-picking and keep the relative valuation disciplined. We present a valuation range, not a single point, showing how each method contributes. Sensitivities make the drivers explicit. For DCF, a two-way table on WACC and terminal growth. For comps, ranges across multiples and peer percentiles. We highlight key swing factors such as pricing power, churn, or CapEx intensity, and show how realistic changes move value. Where methods diverge, we reconcile briefly, e.g., precedents include control premiums or synergies. Trading comps reflect current market risk appetite, then explain the weighting behind the final range. We state the data cutoff date, e.g., financials through June 30, 2025, and any material limitations, missing segment data, limited cohort history, or sparse private comps. We flag non-recurring items and adjustments, restructuring charges, one-off gains, stock-based comp treatment, and normalization of working capital. We close with a clear, defensible valuation range grounded in the methods and sensitivities shown, noting key dependencies that could shift value. This transparency lets readers replicate the analysis, pressure test assumptions, and trust the conclusion.